Everyone wants to know where the stock market is headed. And to do that, we're relying on the Richardson Bass Quant, which is our exclusive technical and fundamental analysis of the market and of various commodities. We're happy to say that we correctly saw the rise of gold, we saw the fall of natural gas, and today, as of June 2010, we're saying that those two trends will continue. Gold we see rising to $1,400. Natural gas at $5 doesn't make enough money for producers in Alberta and many other small producers to survive. Yet the larger producers continue to frack shale gas in such quantities that they keep their own commodity price down. The third commodity that we've been following is oil. When oil hit $147 a barrel, people predicted that the end of the world was coming. Instead, that high price and then the collapse on Wall Street drove oil down, down, down by more than 50%. Today it's around $74 a barrel. Our forecast is triple digits. Oil is going to rise within the next year to more than $100 a barrel. That is a heavy tax at that point. But at this point, it's a bonanza and an opportunity for investors. What we're also seeing is the revival of the banking sector in the United States. Do you remember what happened when Lehman collapsed? There were predictions of the end of the world. The end of the world because Wall Street was ending. When that didn't happen, they said, well, it isn't the end of the world, but certainly there's going to be another Great Depression. Things will be terrible. There'll be breadlines, thousands and then millions out of work and out of work continuously. Almost the end of the world, but certainly a Great Depression for decades to come. When that didn't happen, again, the media changes its tune. And the prognosticators change their tune. So it isn't the end of the world, but it's terribly, terribly, terribly bad. And terribly bad will last for a long, long time. Now the economy in the world appears to be reviving. China and India have growth rates of 8 and 7%. Even Canada has an alarming growth rate to the extent that they're now talking about raising interest rates in Canada. Europe is suffering under the pigs, the nations that haven't got their debt under control. And America and American headlines reflect that. The end of the world in Europe means the end of America. That is just not so. You have to see beyond the headlines. Certainly one of the VIX standards that we watch, the VIX shows that there's a great fear in the marketplace. The VIX has risen substantially in the last few months. Today when you see Wall Street bouncing around $100, or rather 100 points up, 200 points down, 300 points up, 100 points down, the VIX reflects that. And so that is of great concern to our prognostications. But we're still forecasting a rising market, a market that may rise as much as 1/3 over the next 2 years. Where are the opportunities in the market? It isn't going to be a broad-based rally. It isn't going to be an economy that bolts to the top, but it's an economy that is in steady recovery. And the recovery that we see first are in the beaten down sectors. We've been champions of Bank of America, Citibank, JP Morgan Chase. Now, in the banking sector, and again the hardest hit sector, there were predictions at one time, and certainly Citi was taken over by the American government. Lately they've been able to sell off a substantial amount of those shares, but the government still has the reins of Citi, just as it has of General Motors. That will lessen over time. Citi in its most recent quarter announced that it was writing up the mortgage values. That is, that it had written them down too sharply and now was taking back $800 million. The reviving economy is seeing people employed. Certainly not in the numbers that we would prefer, but in numbers large enough that they can pay their mortgage, they can pay their credit bills on time, and actually shows that they are expanding credit buying. These are positive signs for the economy over the long term. So at Citi, currently at around $4, we're seeing that it could double and even more in the next 2 years. Bank of America is in the same position. It was derided and laughed at because of its buying of Merrill Lynch. But when the economy revives, and when Merrill Lynch is now seeing billion-dollar trading days on Wall Street, Bank of America is profiting mightily from the stock market revival. Its own shares are up more than double where we first started buying. We are still predicting a double on Bank of America, currently around $15 to $30 within the next 2 years. JP Morgan is a slightly different story. It isn't nearly as speculative as Bank of America or Citi. It is certainly aligned with the Wall Street bankers who are being pilloried in New York or in Washington. But that type of backlash gains votes, but it won't stop JP Morgan Chase. You're buying the finest brains on Wall Street when Morgan Chase is at $40. Again, we see it rising, not doubling, but we see a 50% rise over the next 2 years. In the case of oil, we've long been fans of peak oil, although I cannot predict to you if peak oil really is going to exist, if production has reached its top in the United States. But it appears that in an economic revival, oil demand will revive as well. Every year in China now, there are 1 million more cars per month being placed on the road. All of them, at least 99%, require gasoline. China is scouring the earth for oil and other commodities. That brings pressure to bear on the commodity price. So after the fall, because of the scare, below $70, oil is revised to the current price of $74. And again, we're seeing a demand around the world that will rise to $100. Our two greatest suggestions for you, and they're only suggestions, are Chevron and Exxon. In both cases, and in cases that you might study in other oil companies, they are not replacing their oil reserves rapidly enough. The total reserves that Exxon show an increase, but that's because they're allocating natural gas as oil. And that is allowed under present accounting rules, but isn't quite cricket. For those that are unafraid of the Canadian oil sands, look to Suncor. Oil sands are a steady, reliable source of fuel in a time of world turmoil. The United States must buy more and more of its fuel from outside its boundaries, and it will simply hold its nose and buy the Canadian oil.